Welcome back to another episode of Fairways in Finance. My name is Jeff Smith. I'm your host, and here to talk to you today about what the heck is going on in this market. So this is the end of August, and we've seen a spike in mortgage rates over the last 6-7 weeks. And so, as a mortgage professional, that's been very disappointing. We just keep thinking that we're getting closer here to mortgage rates coming down. It hasn't happened quite yet. But there's some interesting dynamics going on in the market that are affecting rates right now. And so, the Fed, they are the main driver of, what's happening with rates because they can influence rates by their adjustments of the federal funds rate. And so the Fed funds rate, just as a refresher, is an overnight rate that banks pay to borrow money from the Federal Reserve. So the banks borrow money from the Federal Reserve all the time to give them liquidity, and they pay an overnight rate to borrow money from the Fed. So that overnight rate is the Fed funds rate. So as Federal Reserve increases rates, they are increasing that Fed funds rate. When the Fed increases the Fed funds rate, that will change interest rates on certain products dollar for dollar in terms of the percentage. So if the Fed raises the Fed funds rate 0.5%, you're going to see the interest rate on your credit card go up by 0.5% immediately. You're going to see the interest rate on an auto loan go up immediately. Home equity lines of credit. Some loans, you're not going to see an immediate change in rate like mortgages because mortgages end up becoming what are called mortgage-backed securities. They're traded on Wall Street in the open market. And so the value of mortgage-backed securities is what determines the rate that's available with mortgages. Now, mortgage-backed securities are long-term bonds. So they tend to track what the long-term bond market is doing. And the long-term bond market is influenced by where other rates are at and what the economy is doing overall as a whole. So when the Fed hikes rates, it does have an indirect impact on mortgage rates. And a lot of times, historically, when we see the Fed hiking rates, that actually helps mortgage rates. And we usually see mortgage rates come down as a result of it because the economy slows down when the Fed is hiking rates. When the Fed keeps interest rates low, borrowing costs are very low, and that stimulates economic growth because people can leverage debt to go out and consume goods in the economy, and then that drives up the economy. So what we've been seeing, is the Fed hiking rates for over a year now, but the economy hasn't slowed down in a significant way. Now, inflation has come down. A lot of metrics have improved, but some of the metrics that we look at have remained relatively strong. And the one that is still remaining strong, at least as it appears, is the jobs numbers, the jobs reports. And so there's actually been some revisions to the job report over the last couple of months, significant revisions downward. So these jobs reports, a lot of it is based off of modeling and projections. And so the modeling that's being used right now in some of these key jobs reports turns out to be way off. These models and these reports cannot identify the exact number of jobs that are out there. What they do is they run surveys with employers and employees, and they look at data, they look at payroll data, they look at in a bunch of different areas and then extrapolate all that information and try and come up with what the jobs numbers are. And so it's turning out that some of the modeling that's been used over the last year is overinflating the jobs numbers. So the market is trading based off of the metrics that they see. And the market has been making a lot of trades based on the fact that the jobs market has been appearing to be really strong, and a strong jobs market would indicate a strong economy. And if the job market is strong, that means people are earning wages. People have been really getting an increase in wages, not only if they stay with their current employer, but if on average over the last year, if someone has left their employer, they're getting a pay raise of on average 15%. So people are earning more money. If people are earning more money, that gives them more money to spend. And then having more money to spend means that they're going to spend it in the economy, and that props up inflation. And so inflation is the main driver of mortgage rates. So the stronger economic activity is, then generally speaking, the more inflation we're going to see. And our biggest problem and the Fed's number one mandate with all these rate hikes has been to cool off inflation and bring inflation down. So the jobs market would kind of work in the opposite direction of that. So with all of that being said, what we've seen over the last 6 weeks is that the inflation numbers are lower, but these jobs numbers have been really strong, and so that's actually caused an increase in mortgage rates. And so mortgage rates went up almost 0.75% over the last month and a half. We are at the highest that we've been all year. We are getting almost into the mid sevens on a 30-year fix with no points. Now that sounds like insanely high, but it's really not when you look at it from a historical perspective. So looking back over the last 30 years, the average 30-year fixed rate mortgage is 6.5% for the rate. So right now, we've been getting into the low sevens, and that's a little bit above average, but not extreme by historical measures. Now, if you compare it to the all-time low rates that we saw during COVID, it feels very extreme. It's over double the rates that we saw for mortgages during COVID. So in that perspective, mortgage rates do feel very high. But if we think about it in a broader, longer term perspective, mortgage rates really are not super high. They're just above average. So now mortgage rates have had a nice improvement over the last week or so. And what's happened over the last week is it's come out that these job report models need to be revised downward because they're overinflating the jobs numbers, and the job market is not actually as strong as some of this data has suggested. So now we're seeing some improvement in mortgage rates as a result of that. And so going forward, a lot of what happens is going to be dependent on what the Fed does. And so we're thinking that if these jobs numbers continue to weaken, then it makes it more difficult for the Fed to hike rates again. If these jobs numbers don't come down and we don't see additional revisions lower, then the Fed may hike rates again in the month of September. So this is going to be interesting to see how it plays out. But there is no doubt that the economy is slowing down. The jobs market is not as good as it was 6-12 months ago. And so we're definitely going to see the rates come down. It's just a matter of how much longer that's going to take. But for right now, we're on a good little slide. We haven't quite hit that point yet, though, where we're hopefully going to see rates come down in a meaningful way. I think we'll see that once the Fed starts to pause, because hopefully when the Fed begins to pause their rate hikes, we're getting strong data that the economy is slowing down in a significant way. And so, I say hopefully, that's hopefully in the eyes of the mortgage industry. I'm always, as a loan officer, I'm always kind of rooting against the economy. When the economy is struggling, that's when the mortgage industry tends to do very well, because mortgage rates come down when the economy slows down. And then when mortgage rates go down, people are refinancing, people are buying homes. And so it spurs activity as a loan officer. So it's always kind of a difficult dichotomy in the mortgage business, because in some ways you're rooting for the economy to do poorly, because that generally helps real estate. So that's what we're looking at going forward here. That's what's happening right now. Now, home values during this whole thing are going up. And so normally when we see an increase in interest rates, looking back, over the last 50 years, when we see an increase in interest rates, we see a decrease in home values, because mortgage interest rates drive demand. So the lower the rates are, then generally we see stronger demand to buy homes, because it's less expensive to finance a mortgage. You can buy a more expensive home with a lower payment, and that brings buyers into the marketplace. First-time home buyers can get into the market more than they can when rates are higher, because monthly payments are lower due to lower rates. So lower rates drives an increase in demand, and then we see the opposite happen when mortgage rates go up. When mortgage rates go up, we see a decrease in demand, because it's more expensive to finance a mortgage. That same, $500,000 house or whatever the number is becomes a lot more expensive on a monthly basis. So mortgage rates very much affect the demand of the real estate market. Now, what's happened here over the last year and a half is June of last year, we had already started to see mortgage rates increase. So rates really started increasing at the beginning of 2022. Home values continued going up as we went through the first 6 months of 2022, because rates were, inching their way up. They don't just go up overnight. And then, so as we started seeing mortgage rates increase, we saw a slowdown in the real estate market. And then we even started to see home values come down a little bit. So looking back from the peak of home values last year, which was June of 2022, we saw interest rates increase through that period of time. And then as they continued to increase, we actually saw home values come down. So from June of 2022 up through January of this year, we saw home values pull back about 3%. So real estate market lost about 3%. This year, mortgage rates have stayed relatively flat. They're actually a little bit higher now than they were at the beginning of the year. But we've seen home values go up significantly. So home values, depending on which report you look at, home prices, home values are on pace to increase between 7 to 10% this year, which is crazy when you think about it, because the average rate of appreciation for home values is roughly 3 to 5%, depending on the year. So for home values to increase 10%, that's well above average. But we have interest rates that have risen significantly. And so that really, normally we would not see that happen when rates have moved higher. But what's happening in the market right now is a very low inventory of homes for sale. The supply available in real estate is very low. So even though the demand is lower than it would be in a strong, balanced market, we're seeing prices go up because the supply relative to the demand that's out there is extremely low. So it's just, simple economics. When you have more demand than you have supply, that pushes prices higher. And so that's what we've seen this year. So it's really an interesting situation. And what I think is happening with that is that so many people in the US right now are sitting on a mortgage rate that's 3% or less. They refinanced during COVID. They've got a super low monthly payment. And even if they want to move, they want to buy a bigger house, they want to move to another part of town, they're not doing it because they'd have to exchange a 3% mortgage rate to a 6 or 7% mortgage rate. The house itself would probably be more expensive in price as well. And so now you're looking at a mortgage payment that's probably more than double what you're currently paying. And so that's a significant increase in payment. And I think that's keeping a lot of people on the sidelines from selling their home because they can't afford that significant increase in payment. So the transactions we're seeing right now, are people who are relocating to another state for, family reasons, job reasons, whatever it may be. We're seeing first-time buyers who have now accumulated enough money to get into the market. So even though rates are higher, they're not exchanging a low rate to get into the market. And then we're seeing, like divorce situations or people who've gotten in over their head with too much debt, those types of things. So it's generally transactions for people who are in a situation where they kind of have to sell. There's a life event that's driving that transaction for them. So when we look at the overall number of transactions being done right now, it is 30% lower than it was last year, and last year was down from the year prior. So number of transactions is down significantly, but the supply is so low that home prices are going up. Okay, so what does that mean for you as a buyer, as somebody who's thinking of maybe doing a home purchase? Well, I would, it kind of depends on what bucket you fall into, okay, whether you own a home right now or you don't. But I think something to consider, especially if you're not in the market right now, is that home prices are going up. So if you're waiting for mortgage rates to come down before you buy a home, while you're waiting, the value of the homes that you're interested in buying are going to go up, and you're going to have to pay more to buy that same home. So if rates come down, but the price goes up, you're really not saving much money. Because you can maybe get it at a lower rate next year, but you're going to pay a higher price. So how much are you actually saving? If you buy a home now while rates are still elevated, you're locking in the price of where it's at today. And then next year or the year after, or whenever it is that mortgage rates come down, you can refinance that mortgage to a lower rate, but you've locked in the price from where it's at today. So $500,000 home is going to go up $50,000 in value at a rate of 10% appreciation. So that is something that I think is really important to consider. And then the fact of refinancing, that can get you a lower monthly payment. So as long as you can afford the payment at where the rates are at today, I think a solid game plan is to go ahead and buy today and then refinance when the rates come down. It's not very expensive to refinance either. So you don't have to see a significant reduction in the rate to justify the cost of a refinance. And you can refinance multiple times. There's no restriction on when you can refinance or how many times you can refinance your mortgage. So that's what I would recommend for someone who could afford today's rates and payments. That's going to save you money. Now, other ways that we can combat where the rates are at right now, we can do buy downs on the interest rate. So you can do a permanent buy down where you pay discount points and then permanently lower the interest rate for the entire duration of the loan. Or you can do a temporary buy down. A temporary buy down, let's take a 2-1 temporary buy down as an example. 2-1 temporary buy down gets you a 2% lower rate in the first year, 1% lower rate in the second year, and then you're paying whatever the note rate is of the mortgage from year 3 all the way through 30. Temporary buy down has to be paid for by the seller, and the cost of the temporary buy down, 2-1 temporary buy down, is usually just over 2% of the loan amount, so like 2.1%. Or 2.1% of the purchase price, I should say. But it is calculated based on a percentage of the loan amount. So that cost for a temporary buy down, let's take a $500,000 home. You're looking at close to $11,000 for a 2-1 temporary buy down. That cost has to be paid 100% by the seller because the total cost for that temporary buy down is just the difference in interest over those first 2 years. That's how the cost is calculated. So what happens to that money is it goes into the escrow account of the mortgage, and then every month that you're making your payment, the difference in interest is coming out of the funds from the temporary buy down that are sitting in the escrow account. So let's say in year 1, your monthly payment is $600 a month lower. That $600 is coming out of the escrow account each month to cover the difference in the interest. If 1 year down the road, mortgage rates are lower and you refinance that loan, any unused portion of the temporary buy down funds gets refunded back to you as a principal payment against the loan. So that's a nice way to go to get yourself a lower monthly payment for the first 2 years. Now that's a good deal if mortgage rates come down within 2 years and you're refinancing to a lower rate. But it's possible they don't. So if you do a temporary buy down, it's very important to know what that payment is going to be in year 3 and make sure that you can afford that payment from year 3 through 30 in case mortgage rates don't come down. With the discount points, we like to run a break-even analysis on how much are you saving per month and how much does it cost up front to pay the discount points. And then we look at what's your break-even point on that money. So how long does it take, if you pay $6,000 in discount points, how many months does it take you to save $6,000 on the payment? That's your break-even. So generally right now with discount points, the break-even is north of 3 years. So I don't recommend paying discount points in this market unless the seller is paying the cost of the discount points. If the seller's paying the cost of the discount points, then we're not really concerned with the break-even period because the seller's paying the cost. So it's not an out-of-pocket expense for you. So anytime the seller's paying the cost, I would buy down the rate as much as I could. If I was paying the buy down cost, I would not do that in this market unless the break-even was under 2 years. Because I think the chance of people who are getting a mortgage today refinancing in the next 2 years is very high based on how long rates have been elevated and what the economy is doing right now. So we are in right now the longest rising rate cycle of the last 30 years. So the longer that this goes on, just statistically, the closer we're getting to mortgage rates coming back down. So at some point, they are going to come back down. Refinancing is an easy process to do. So if you've never refinanced a mortgage, you have to submit paperwork to verify your income and your assets. So if you're doing a loan, like any client that I've done a loan for over the last year, I still have their application. We've got all their basic paperwork. So we just need to update some of their documents, run a new credit report, and then we can submit their file to underwriting and lock their rate. There's a lot of cases, depending on how much equity you have, where we don't need an appraisal on a refinance. So, refinances take less than 30 days to close. There's some closing costs, which will vary depending on if you're buying down the rate or not. But any closing costs on the refinance can be rolled into the loan. So you're not having to pay that as an out-of-pocket expense. So when you refinance your mortgage, you're only coming out of pocket with the appraisal fee if a full appraisal is required. That gets paid on a credit card. And then everything else can be rolled into the balance of the mortgage. You skip one monthly payment when you refinance as well. So Say you close on a refinance in the month of September, you'd have no payment in October. First new mortgage payment would be due November 1st. So you always skip at least 1 month after the month that you close when you refinance your mortgage. And again, I mentioned this earlier, but there's no restrictions on how many times you can refinance or when you can refinance. So you can leverage refinancing to lower your expense on your home. And, I think that as we see mortgage rates come down, the market's really going to heat up because lower rates drive demand, like I mentioned earlier. And so it's going to bring a lot of first-time buyers into the market who can now afford mortgage payments at lower rates. And then I think there's a lot of people who currently own homes who will be interested in selling because they want a bigger home, or they want to move to another part of town, or they need an extra bedroom, or they need fewer bedrooms, or whatever the reason is. Those people now, it's more palatable for them if they're exchanging a 3% rate to 4.5 or 5.5 versus a 3% rate to 7 or 7.5. So I think we'll see a significant increase in activity as mortgage rates come back down. But if you wait to buy until that happens, and we're in a very competitive market, it's difficult to get offers accepted in competitive markets. And we saw that during COVID, very competitive market. And it started to get to the point in the Phoenix area where unless you were paying cash, it was really difficult to get an offer accepted because sellers were getting all cash offers from investors and other people, full purchase price, closing in 3 weeks. Would you take that offer, or would you take, the first-time buyer or any buyer financing a mortgage, putting the minimum down and needing a full appraisal to close? And it's going to take 30 days. And by the way, you don't know for sure if it's going to close because they've got to get approved for a mortgage. So the cash buyers get a huge advantage when the market is competitive. So that's what we're seeing right now in the marketplace. It's an interesting time. This is the longest rising rate cycle I've been in my career. This is the longest rising rate cycle of the last 30 years. I do think the foundation is being laid by the Fed for the economy to slow down significantly. We just can't go this long with rates as high as they are, and not just mortgage rates, but other rates as well, without the economy slowing down in a significant way. And so I'll leave you with two more anecdotes here regarding the economy. So one, the money supply during COVID increased by 40%. It was a historic increase in the money supply. The government was printing money, sending out COVID checks, and then they were juicing that up with super low interest rates. So that really juiced up the economy and put a ton of money into the supply. And so what happens when you increase the money supply that much is people can leverage that money, and it becomes 10 times the amount that it actually is. So I'll give you an example. You get a $5,000 COVID check. You go out and buy an $80,000 car, putting $5,000 down from your COVID check. You're financing $75,000. You put $5,000 in cash into that car, but now that car dealership has just sold an $80,000 car from $5,000 COVID check. So that leverage of money really juiced up the economy. The increase in the money supply causes inflation, and it takes a long time for that money supply to then contract back down. And because that was such a historic increase in the money supply, it takes a long time for that to get soaked up. The second thing that we're seeing now is a significant increase in credit card debt. So consumer credit card debt in the US passed $1 trillion last month for the first time ever. So credit card debt is now the highest that it's ever been. And I personally have had quite a few clients reach out to me who've gotten in over their head with credit card debt. And there's lots of reasons why this happens for people, but I think what happened to a lot of people during the COVID years was they were getting stimulus money from the government. Rates were really low. They inflated their lifestyle. And then as those COVID checks stopped and interest rates started to go up, they weren't able to readjust their lifestyle and started financing on credit cards. And now, with the Fed having hiked rates as much as they have, and for as long as they have, every time the Fed hikes rates, it is directly impacting credit card interest rates. So credit card interest rates on average are over 25% now. So even if you don't have a huge amount of credit card debt, 25% interest rate on that debt is significant. And not only that, but student loans have gone back into repayment. if you had to buy a new car over the last year and a half, your rate on a car loan is significantly higher. So all these costs are much higher than they were, and the burden of credit card debt for the average consumer is significant. And so if that continues on, at some point that has to cause a snap in the economy, because the average consumer is going to be in over their head and unable to make their payments. And then that filters through the economy. So something to keep an eye on and watch. It'll be interesting to see how this plays out over the next several years. But one way to combat getting in over your head with debt, if you own a home, is as rates come back down, you can do what's called a cash out refinance and consolidate and pay off that debt. So like right now, I've had several clients reach out to me who want to do a cash out refinance and pay off all their credit card debt and a couple car loans to lower their monthly outflow. Well, rates are so much higher today than the rate that they currently have on their mortgage. That actually doesn't pencil out for them. And so I've recommended a home equity line of credit instead. But if we see mortgage rates get back down into the low fives or the high fours, if you could take equity out of your home, pay off, 50 grand in credit card debt or 70 grand in credit card debt, and maybe pay off a car loan, even if you take your mortgage rate from 3% to 4.5%, your monthly outflow would be significantly less than it would be if you did not pay off that debt. So that's something that we can look at for folks if they've gotten in over their head with debt, as a way to bring their monthly payments as a whole back down to a manageable level. It's called a cash out refinance. So hope you're doing well. Shoot me a DM. I'd love to hear from you, see what you're seeing in the economy. Hope you have a great rest of your week.